Okay, so this is what is this? This is Division 2. This is the tape reading and active trading course. There's a trading course and there's a swing course. So the idea is to use both together if you want, or just use them separately. But I think what Wyckoff has said was if you use them together, it provides great benefits for the trader because you can have very good entries and a lot of reward relative to the risk. So anyway, without going through all that, let's go Division 2 course, tape reading, etc., etc. Let's move into the material. I'm not doing this shit. There we go. Alright. The majority of those who follow our method use the swing trading course, that's what he's saying, to plan their campaigns. This division of our course, like the first division, is based on judgment of the technical position, supply and demand, support and pressure. Support and pressure, you could just replace that by resistance. So again, supply and demand, support and resistance. That's what this really comes down to, by the way. We only use three factors: price, volume, and time. Those are the three main factors. Okay, but notice price, volume, and time. You have to have. There is a fourth factor, obviously, support and resistance, and there's a fifth one called activity, which we'll get into, but not too much because I think volume is enough. Uh, the active trader is the one who trades a lot every day. All right, and in most cases the trades are closed out today. Trade today, close today. Now here, this form of trading disregards the long-term trend of the market. Okay, note that what he's doing here, you don't need to use the long-term trend of the market, but you do need to know the support and resistance levels. All right, and although it disregards the long-term trend of the market, it's very helpful to know what that trend is, and as well as the intermediate trend. It is helpful because like a lot of these moves are uh, they're like counter trend versus part of trend, and it gets and they have different lengths. Okay, very important to note. So he's saying that it disregards long-term trend. You could think of it as like the weekly trend, and the intermediate trend as like the daily trend. It takes instant advantage of the technical rallies and reactions that promise to yield a profit in the stock market. Now, I don't, this right here is different than the swing trading course because he's not going to trade with trend. That's the first thing. But understand that this is a very, very special type of trading, and he is looking at the actual tape. So he's willing to take a counter trend move, he's willing to take a counter rally move, and a lot of people cannot do that. So the recommendation is you really need to know your support and resistance levels and know the trend, even though he's saying that by saying this, he's saying he's willing to counter trend. Alright, but again, like a lot of folks just don't know what what they're doing. So just be aware that what you're really trying to do with this method is take advantage of the current trend in today. The trend of today. The trend of today is what you're trading, not the trend of the week or on the daily chart. The trend of today. That's what he's trying to say. He's not promoting like going against the market or anything like that. He's just saying that focus on what's happening here and now today and take advantage of it. Tape reading is the art of determining the immediate course of trend from the action of the market as it appears on the tape of the stock ticker. Yeah, I know. The next few minutes or hours, like the move, and get in when they start and get out as they culminate, meaning the end. Get in when they start, get out as they culminate. Is nothing more than saying get in when the trend starts and get out when it exits, and how to do that will be covered later. It requires activity and flexibility of mind and readiness to change or reverse one's opinion quickly. This is the biggest problem with people. They just like this is You know, this is the problem. And this is a personal thing that you have to cultivate: the ability to accept an unfavorable outcome, the ability to accept a quote unquote random outcome, the ability to accept and change your mind is a psychological issue. It's not really a trading thing because it means you're okay with being wrong. So there are steps to deal with this, but I don't really see it covered in trading literature. It's covered in, you want to get Mark Douglas's book, either Trading in the Zone or The Disciplined Trader, which is also his first earlier work that really goes into the intricacies of why people, why they can't change their mind because of pain or situations in their life where being wrong equaled pain, and that's how you grow up in society, etc., etc. So the point here is that this is a skill nobody can teach you. Right? You gotta just be ready. You gotta say, you know what? I don't give a, and I'm ready to change my opinion. Also, it's very difficult to do, especially if you're trying to like lead, do a trading room and all that stuff, because there's a lot of judgment and ego involved. Anyway, its purpose is to derive an average profit from a series of trades. You must understand that you're going to be wrong. Why are you going to be wrong? Okay, let me just explain what people don't get. Here's the fact. Alright, 1 second. If you're buying here, right, and you're expecting someone to buy at worse prices than you. You're expecting someone to buy here, 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 here. If you are buying here, why are you expecting someone to buy at worse prices, higher, 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 higher? If you're buying something on sale, why do you expect someone to buy, let's say this is $1. Why do you expect someone to buy it $2, $3, $4? Would you buy it up there? No, you would not buy it up there. So why are you expecting someone else to be the dumbass and buy it at 2, 3, 4, and 5? That's the question. So you're expecting other people to buy at worse prices than you, right? So in reality, what happens is when price goes up here, sometimes people will buy the breakout and they will buy at worse prices. Sometimes they won't. You will not know whether they're going to buy at worse prices until prices reach that level in the future. So I'm not a psychic, and I'm sure you're not either. So this is the thing. This is the rational reason for why you have to anticipate that they're not going to buy at worse prices because you didn't buy at worse prices. So why do you think they're going to buy at worse prices? Are you going to buy up here at 3 when you could get it at 1? No. So trading is built on anticipating that people are going to buy on worse prices and sell also at worse prices. It is this fact that you really have to question. Will people buy at worse prices? Will people sell at worse prices than you? Sometimes they will and sometimes they won't, and it's quite rational for them not to. Therefore, you don't know until price goes there to see if they're going to buy at worse prices or not, or sell at worse prices. So this is why this bullshit about the bull flag going down and making an equivalent move, this right here, this also is a judgment call on people buying at worse prices. Think of how ludicrous it is to assume that you're going to buy here and everybody else is going to keep on buying higher. Like, would you do that in real life? No. You want people buy at better prices than you. They don't want to buy at worse prices. Same thing with this head and shoulder nonsense. Oh yeah, the head to the shoulder, blah blah blah, it's going to go down. Again, you're assuming that they're going to sell at worse prices than you, which is going to cause the market to go down. So all of these methods assume people are going to buy at worse prices than you, and just taking away technical analysis, how ludicrous is it that people are going to buy at worse prices than you? And that's why you don't really know what's going to happen next. And all targeting methodologies assume people are going to buy at worse prices than what you're buying at, and the trend is going to continue. Okay, so that's the thing. Anyway, I'm not going to go any more into that. Let's continue. Its purpose is to derive an average profit from a series of trades by keeping the risk down a minimum and constantly striving to reduce it by clever manipulation of stop orders, blah, blah, blah. What he's saying is, listen, buddy, you're going to be wrong. Alright, that's why you're going to make an average profit over a series of trades, because you can't assume that everybody's going to buy at worse prices than you. Sometimes they are, sometimes they're not. So what does that mean is that you, in the cases that they do buy at worse prices than you, you'll make a profit. In the cases that they don't, you'll have a loss. And that's quite a rational argument. Anyway, all commitments are temporary. Their duration is usually limited to hours. They are intended to take advantage of small immediate fluctuations. Again, in this style of trading, which is the tape reading, you're trying to make money today on the trend today. That's what you're capitalizing on, and you're trying to make money off small immediate fluctuations. You're not going for that big move, because you're going to get in today, you're going to close out today. With this method as a trader, you search for your opportunities right here and now, today, today's trend, today. In most cases, you will prefer to go home with a clean sheet. At each morning's open, make a swift analysis of the market, sense the trend, decide the best stock, and if conditions are favorable, you make a commitment. This is a little framework, actually. Like, people don't realize that when they read this. In the morning, at the open, you do analysis. You don't just trade. You do analysis at the open. Second, you sense the trend. How do you do that? It doesn't say yet, but we'll get to that. That's step 2. Step 3, decide the best stock. How do you do that? Talk about that later. Decide the best stock. So, market trend, morning, today's trend. 2, get the best stock, and if conditions are favorable, make your commitment. So it's basically the trend today, picking the best stock and going long or short. And you do that at the open. That's when you start it off. Then you watch the market for a confirmation. Step 4, confirmation or contradiction of your correctness of your position, which means you must anticipate you will be wrong. In fact, if you have a 50-50 mindset, it's even better. You have to anticipate that your sensing of the trend and judgment is incorrect, or at least that it's possible that it's incorrect before you trade. So you are looking for confirmation. You are looking for contradiction or correctness. You might be hoping for correctness, but you must be objectively, like, a step in this method is when you're actually looking for the correctness or contradiction as part of the execution of the trade. You look to see if the market is going to contradict you or not. Also, for the psychological moment of moving a stop, Um, Thus, you are affording several times as many opportunities. Trading, thus, you are not that many in a day, but in these small swings you have, if you wanted for the more important swings of 10 to 30 points. Let's go back to that. Um, what do I do? Trading, thus, you are afforded several times as many opportunities. All he's saying is you got a lot more opportunities, meaning more trading every day. Now, understand this, more trading doesn't mean more money. Okay, for some people it does, but in general, there's numerous, um, I don't know if there's studies or whatever, but more trading actually leads to loss. That's if you trade too much, it can really mess with your mind. And I think the recommendation is 1 to 3 trades a day max. Anyway, and only when new trends emerge. So you have good reward potential. If a trade does not make good at once, you close it out, whether it stands even or it's small loss. Again, if the market contradicts you, you close it. You will never trade without a stop. You for and the risk must be kept to a minimum. Again, you have to use a stop, but note like it has to be placed accurately. A lot of folks will put it below the bar or put it in the worst position that a spring can get it at it or an upthrust can get at it or so I don't. You'll see how Wyckoff does the stops in the study. You'll never take a big loss. You'll keep the stop at a minimum, but a minimum doesn't mean a tight stop. Like this is one of the biggest problems that you see is people will put their stops in the worst places. Like they're trained to do that, by the way. Keep a tight stop, keep a tight stop. And the pain of loss with the stop that's further out is significant. So they don't want to go through the quote unquote fear of loss. Anyway, you will never trade without a stop. Okay, you can clean house in an instant. This form of trading is entirely different from the swing trading course, which aims to secure a profit of 10, 20, 30 point swings. It meets the requirements of those who want to trade a lot more continuously, including in the division of the course that plan for charting. We're lucky that we don't have to do this. Um, it shows you how to close your trades the same day uh, by watching these tape reading chart indications and getting out near the extreme points in the advances and declines. Under this method, you might take a new position 1 to 3 times a day. Notice, this is not a scalping method. This is not a scalping method. This is intraday trend trading method that Wyckoff is describing. Not a scalping method. Depending on the activity of the market, it is the closest yet to the exchange or floor trader or whatever. But the most important advantage, now here's where it gets interesting. The most important advantage of a combination of the tape reading and trading for the long swings is that it will aid you in increasing your profits in this way. Section 1112 of the first division of our courses show how to determine which stocks should move 3 to 5 points in a certain direction. Okay, so in the swing trading course, it tells you that this course is going to go You apply the tape reading method in making your trade at the most favorable moment. What does that mean? It means that even if you're using the swing trading method, you can use the method that's described in this course, which is different than the first course, for entries. That's it. For entries. And the position you take with a small risk. And then he starts talking about the position sheet, about it going from one position to another position. So position 2 or position 4, and indicate a run of 10, 20, 30 points in your favor. So it's very valuable for something to be in certain positions on the position sheet where it's ready for a long move. If it's ready for a big move and you time it right using this method described here, the risk will be minimized and reward will be maximized. So this method actually allows you to have such trades, and that's a huge edge. And we're not talking about 3 to 1. This isn't your 3 to 1 style trading. This is like like 10 to 1. So um, and thus trading with a fraction of point of original risk and letting your profit run into many points indicated in your forecast of the distance. You see? Many points versus a fraction of a point. You greatly widen your margin for profit. So this is why he did division 2. Division 2 is the entry method. Division 1 is picking the stock, etc., etc. Division 2 can be applied as a method of entering the stocks you've identified as good candidates in Division 1 of the course. Okay, and combining the two, you will increase your margin for profit, which basically means you have more reward, even much more reward than risk. For this reason, the tape reading instruction combined with our longer swing plan will materially enhance the profit possibilities in both divisions of the course. Okay, what does that mean? That means it means what it says. I mean, if you just trade intraday, you'll get intraday swings and counter swings and trade a lot. If you just use division 1 of the course, you will just trade for the swing, but it won't be an opportune time. But if you combine them both, that's very powerful. Very powerful. Because from the perspective of risk and reward, it is, I don't mean to say very powerful, but it's like very advantageous because you maximize the reward relative to the risk. And but I mean, like, you really need to know the first division of the course. So and combine the two. But I don't really see people doing, like, I don't see anyone on the internet or whatever doing division 1, division 2 and applying it in reality and targeting it for stocks. Even me, I'm looking at the currency market or the YM, but combining the two is going to be beneficial to, I guess, everyone, me, you, whoever's listening. So anyway, moving on to the next. Judging the immediate trend. For this purpose, we use a wave chart. Again, how do you judge the immediate trend? You use a wave chart. A wave chart, alright? Not just a bar chart, a wave chart. Made up of price of most of the leaders of active leading stock. Now, you don't really need to do all that because I mean, I've done it so many times. I don't know what did he have that. I don't think he had intraday, uh, like the New York Times index or whatever. So now, now you're not stuck with doing a wave chart of most active leading stocks. This can be done, and I will do it later because as an experiment, I'll do it to see like if that wave chart of leaders moves quicker than the S&P and the Nasdaq. So I think I'll probably do that. Um, but anyway, like you don't have to. You just use a wave chart on top of any of the indexes today. So you could use the S&P ES futures, the Nasdaq or Dow. Okay. The price of these are added. You don't need to do any of this, so let's just skip it. Okay, now it's going to get interesting. All markets are made up of alternate buying and selling waves. We judge the strength or weakness of the market by the distance in points and fractions recorded by the waves. We combine this with the length of time of each wave. Basically, he's looking at the rally versus the reaction. How much distance did the rally cover? How much distance did the reaction cover? How much time did the rally take, and how much time did the reaction take? It's not rocket science. It's a rally and a pullback. So let's say this went up 5 points. It did that in 15 minutes. This pullback went down 2 points, and it did that in 10 minutes. Okay? So 5 points in 15 minutes, 2 points in 10 minutes. Which side is stronger? Well, more distance, 5 points versus 2 points, and more time, 15 minutes versus 10 minutes. Obviously, the long side, the bulls are stronger. Bulls are stronger. So that's what he's talking about right here. All movements are made up of alternate buying and selling waves. We judge the strength or weakness of the market by the distance in points and fractions of these waves. We then combine it with the time or length of time. In studying the distance and duration is nothing more than the price change and the time, the length of time. For example, 5-minute chart, the length of time was 3 bars. It's 15 minutes. All right. If the buying waves are longer in duration and travel further than the selling waves, we get the indication that the immediate trend is up. If the selling waves exceed the buying waves in time and distance, the immediate trend is down. Whenever the buying and selling waves seem to offset each other, there is no material strength or weakness. No strength or weakness. And the immediate trend is in doubt. Our position should then be neutral. So again, show this. You're looking at the buying wave, 15 minutes, 5 points. Selling wave, 2 points, 10 minutes. Who's stronger? Here. Immediate trend is up. Alright? That's all it is. Now he's going to add more to it and show the variations, but a moment in time where these two swings are considered, the immediate trend is up. Okay. So basically just compare the rally to the pullback. Select the 5 leading stocks at the open of the market. Okay, this is how to combine those 5 leading stocks. You don't have to do that. Software does it for you. so we're not going to go through that. The immediate trend is indicated as soon as one buying and one selling wave have completed. So the style of trading from the open, right? Like the style of Wyckoff's trading at the open is all he does is look at a rally and a pullback. So let's just say this is your session line right here. This is your open. He sees the rally and he sees the pullback. He's looking at the time and distance, time and distance. Okay, on the reversal, long. Long. That's simple as that. That's how he's trading the open. Open, first move up, rally, first move down. Okay, gets a clean indication. Long. That's how he's trading the open. Now I know this seems simple, or you might be like, oh, that's it, or what, whatever. But there's more to come. So, okay. But you must always be on the lookout for a change in this immediate trend. Why? Okay, before that, let's go up here. The immediate trend is indicated as soon as one buying wave and one selling wave have been completed. You then know on which side is the most power, the buying or the selling. And all you have to do is go with that side. Okay, now you're going with, after the pullback, you're going with whatever side, but understand, but you must always be on the lookout for the change in this immediate trend. It is likely to change from 1 to 3 times in a single session. Now note, if it's a choppy session, it is very difficult to trade. Alright, because it can really be a pain. Alright, this is how you detect the change. Okay, this is a very important line here where we look for a change in trend. In an uptrend, when the selling waves begin to increase in time and distance, or the buying waves shorten, either or both will be an indication of a change in the immediate trend. So what he's saying is when you have this, okay, you have to be on the lookout for a change in trend. What happened? The selling waves got bigger and the buying waves got smaller. So the pullbacks are now on the selling side. Alright, that he's looking for a change in trend. The other thing about the shortening is that it's a reference to the shortening of the thrust, which happens like right there. The thrust has shortened from high to high to high to high to high. So that is shortening, the thrust is shortening at this final high up here. So when you're looking for a change in trend, you are looking for two types of behaviors. Well, what he's describing right now. One is in an uptrend, you're looking for a sign of weakness and a shortening of the thrust. Okay. Now some may also add to this list a climax, you know, and testing and all that, but not going to go into all that yet. Remember that you have nothing to do with other trends of the market, either the long or the intermediate. The latter swings are based on the first division of this course. Trading for those swings is an entirely different proposition, requiring less time and attention, but having the objective of large profits. More detailed instruction regarding the above wave chart will be found in the division of the course. We'll get to the wave chart later. Although the buying and selling waves may be sufficient on certain days to carry the market in a certain direction until the close, this does not mean that it will continue to do the next day. Remember, the trend is here and now today. So this style is allowing you to trade today. And it does not mean that you should carry trades overnight because of this, because tomorrow's trend will define itself tomorrow, not today. Different. Such a reason would be, for example, okay, this is when he's saying hold it. Um, in such instances, a long position, for example, might be allowed to run with frequent. Okay, I'm not going to go into that. All of this really says the only time you hold it is when you have a huge objective and you're combining the two, Division 1 and Division 2 of the course. The wave chart teaches tape reading. This is very important. The wave chart teaches tape reading. I've already shown this. What is the tape reading here? More time and price on the upswing versus the downswing. Therefore, the bulls are in control. These two, price and time, are factors of tape reading, and we've applied them to identify the bulls are stronger. Wave chart is used to teach tape reading by observing price and time on the swings and then comparing them to see which side has the greater pulling power. The wave chart teaches tape reading after you have used it for a while. You may not need it. Your eye and brain will also detect it. You'll see in an instant when the change is coming. Just as a champion knows how to hit a golf ball, you'll know intuitively after you practice it for a long period of time and years. But do not abandon this chart. It will come only after long experience and much practice. So basically, what he's saying is use the wave chart. Okay. The 5 leaders should always be representative of the market. This is the 5 leaders that consist of the wave chart, or you could just use the intraday S&P or the whatever, you know. And he's saying like how to pick them. We're not going to go into that. It's better if you just go with the S&P or the Nasdaq. And over here, like he's big on this, on selecting leaders, because there's something about the leaders. All right, they tend to, any significant change impacts the leaders because big money is in the leaders. It's not in penny stocks. It's in the leaders. So he wants to keep like the 5 or 8 when he's creating the Wyckoff wave of leading stocks. I'm going to go into like a quick way to do that later. But point is you have to actively like change depending on which leaders. And here he gives an analogy. You have 5 horses, well, let's say you have 6 horses. You keep the 5 that are leading and drop the 6. All right. So you want the leading, who's leading, and you just add them. You just take them up and you add their prices. This can be done very easily, by the way, by using software. I've already done it, and it's not rocket science. But I mean, some software will not allow you, so you need good software. Uh, the wave chart of the previous day should be before you when the market opens. I mean, you can use yesterday's wave chart or you can use a higher time frame chart. This pair up here says only use leading stocks. So, I mean, you can use the S&P, and I recommend just using that for now. But ideally, you want to use leading stocks and just have your software like chart it for you. Wave chart of 5 leaders. So these are the leaders. What are the leaders doing? They're going up, 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 and then this is yesterday, this is today, this is this is today, this is yesterday, this is day before, this is day before. So he's just combining them. All right, showing the sum of their prices from hour to hour during 4 consecutive market sessions. What does that mean? It means he's using an hourly chart. Okay. He for tape reading he uses a 5 minute chart, but this one is an example of him using an hourly chart, an hourly chart for the wave chart. And the stocks he used in this chart are 1, 2, 3, 4, 5: steel, General Motors, electric, American can. This can easily be like, for example, when they're relevant, it can be your FANG stuff: Facebook, Apple, Google, Netflix, Amazon, right? So that could be like a list, but you want to use the leading. So like Amazon, I think I forgot what the price is, but I think it was leading. So it's the combination of the leaders and watching them. And the thing is, like, even though I'm saying use the S&P for now, like using the leaders, they do turn before the rest of the market. So we'll see that later. Anyway, so this is the hourly wave chart. He's just giving an example. It's very easy to do. Uh, on almost any platform, you have a zigzag indicator. So use the zigzag indicator. We'll talk about the retracements later, but you know, you use a zigzag indicator with decent amount of retracement. Do not use minimum tick. Do not use 1 to 2 ticks or 3 ticks even, because it gives too many waves. You want to play with it and give a good retracement size on the zigzag. And then most zigzags have labeling options. So label it with price and time, like I did over here. Price and time, price and time. Alright, so 5 points, 15 minutes, 2 points, 10 minutes. This could easily be over here 5 minute, 5 points, and down here could be 30 minutes, 30 points, for example. Alright, so wave chart of 5 leaders. And also, when software is being used, like, you could even create equal weighted. He's just adding it up, but I see it could be equal weighted also, 5 leaders, so that one high price stock isn't dominating the wave chart. Okay, we're done for now. Next section will be buying and selling waves. Alright, and once again, I'm going through both courses, Division 1 and Division 2, whatever I feel like doing, a little bit of this, a little bit of that. We'll see how long I can continue this. The idea is, like, for people who are watching, you're not going to learn shit if you don't read the course. You can't watch a video and learn the Wyckoff method. So you need to go read it, watch the video, apply it by having a wave chart on your software. There are many softwares that have wave charts. Every software, NinjaTrader, Market Delta, eSignal. I think Weiss sells his some Weisswave, but everything has, Sierra Chart has what else? Yeah, I don't know. But the point is, you want zigzags and the software that has ability to plot volume, price, meaning the change in price from the swing low to swing high, and time, whether it's a 15-minute, 20-minute, 30-minute. Like, so that's all, folks. Take care. Bye.